Welcome everybody to Market Masterclass, and today we're delighted to have with us Nigel Ball, who's got many links with registered investment companies around the world and has a lot of knowledge about what's going on around the world. So what we thought we'd discuss is go by continent to continent, and first of all, if I just let Nigel introduce himself, and then we'll discuss the various continents and the potential for investments over the next few years in all those continents. Nigel.
Morning, Bruce. Yes, Nigel Ball, a long-term expat from the UK who worked previously in the UK, worked for Gartmore, worked for Framlington, worked for AXA Equity and Law, where I rose to be head of sales, worked for AXA Equity and Law Unit Trusts. Came out to Asia in 2001, worked mainly on the life side until 2011, when I joined a friend of mine in Hong Kong in a distribution business where we distribute mainly unit trust companies from North America and or Europe who don't really want to have sunk cost in opening an office in Asia. So we do Pan-Asia distribution for 4 or 5 different unit trust firms from Europe, UK and Canada.
And they have funds?
Yeah, very much a different approach. I mean, the Canadian company are very much commodity related, gold, precious metals, 3 or 4 different funds available to international investors. The UK firm, couple of UK firms that we operate for, again, quite a variety of funds. 2 of them offer sort of global algorithmic asset allocation funds, which I think are really core funds for investors, retail investors, particularly in the environment we're in at the moment. Then they have the one firm has a couple of specialist funds, a commodity trading link, which again I think could be quite useful in the environment we're in at the moment, and a specialist London property development fund, which I think is excellent but doesn't actually get much traction in the markets in Asia because some of the recent history I think that's happened within the retail market, which I understand. And then I operate for a specialist, very specialist algorithmic, artificially intelligent trading fund out of London. Very new, very exciting, but probably not retail market, probably more very upper end retail market and sort of family office private banking market.
That's computer controlled.
Very much computer controlled, yeah. Algorithm based on 7 or 8 years of data, and then they work with guys at MIT to develop artificial intelligence. So it looks at the last trade and adjusts the algorithm to trade going forward. Based on history, could make retail clients a lot of money, but I think very much a small part of any portfolio. I think really, in my opinion, retail clients this year probably want very much an actively traded global asset allocation fund that it forms a core part of the portfolio. And if there was a year for core and satellite, for me this is probably it. Pretty well, yeah. Either within a single fund or as a fund manager that specialises in different parts of the world. Sure.
What do you see are the sort of benefits, if any, of Asia?
Asia I still like. I think a lot of people don't. I still like Asia as a play. I think China will always have the ability to surprise. I mean, you know me fairly well. You know I've lived in Singapore, Hong Kong, Kuala Lumpur, and now the Philippines over that 16 or 17 years, and everyone I know in Hong Kong, local, will tell me, don't even try, you'll never get to understand the Chinese mentality. And I think that's been proven again. They've just delivered on their GDP figures for last year. And I think China, the market, will always have the ability to surprise. I think very much it's probably a domestic play in 2017, a focus on maybe infrastructure, domestic consumption, But always buying through Hong Kong would be my advice. So funds that buy H shares through Hong Kong.
Any other?
I think India. I think Modi as Prime Minister there has done a good job. I think most of the Indians I know actually think he's doing a great job. I think this removal of the black money from the economy has helped a lot, and I think India has got a way to go. And then I'd say it depends where you put Russia as a market. Do you put that in the Asian economy, Greater Asia, or do you put it in the European economy? I think Russia, strong play last year, and I think potentially at the beginning of this year could be a very strong play again. I think very undervalued market. I think, stock market trading at 5 times long-term PE, even though it was the strongest market in the world last year, has a huge way to go. And I think, the wins behind Donald Trump in these early days look like they might favour Russia and a settlement with the US and a lifting of restrictions, and that can only be good for the investor.
What about, that point,
I think North America is going to have a lot to deal with. I think, we've seen the US print money since 2008, and there comes a time in the reckoning where everyone has to deal with huge supplies of money in the market. Typically, I think in history, certain modern history, people have dealt with it by going to war. And I think we hope that doesn't happen. I don't think it will, but I think that's how people have, they've dealt with mass unemployment and they've dealt with issues around currency by going to war and creating false economies. I don't think that will happen this time, but I think the US will have to face up to the fact that they need to monetize debt, and that probably means a lowering of value of the US dollar.
Because China owns a lot of American debt.
Right, so I think between them, Japan and China probably own a huge amount of American debt. And that's probably a good thing while Donald Trump keeps them on side. I think if they were to dump that debt in the market, that just exacerbates the problems that the US face today. I think in terms of a play for the retail investor, I think the US has to be in anyone's portfolio. It's the biggest stock market in the world, you can't ignore it. Even if you were a sterling investor, you need to have a hedged play in the US. I think the US, under the Donald Trump regime, very much an internal looking, make America great again. I think very much an internal play. So I would look at infrastructure companies, again, consumer suppliers, local manufacturers that are supplying stuff for the American economy, rather than exporters. I think the car companies and things like that will always do well. And I very much think that, it is the consumer that's voted Trump in. So I think, the consumer orientated stocks are going to do very well. And I think, people are going to buy American. Those that believe in Trump, the lobbyies that don't, will obviously probably rally the other way and won't buy anything American. But I still think North America a strong market. I think we're seeing some movement early in the year in the commodities market, and therefore an exposure to Canada could be a good play as well. TSX 50, the Toronto Stock Exchange, very much driven by miners and commodity play. And we know that over the last few years the miners took a beating. Along with the drop in gold, mining stocks took a bit of a hammering. And I think, they look like they could bounce back. This could be the year to bounce back. In isolation, I wouldn't personally make any of those plays, but as part of a global asset allocation fund or around a core holding, it might be worth, a small 5 or 10% in those type of stocks. I think the US will always be in any global multi-asset allocation fund. Yeah, I think just you can't ignore it.
Going south then, what about sort of Central and South America? Any sort of plays worth looking at there?
I think not in Central America, in my own opinion. In LATAM, I think in the early part of the year, I think there's still some mileage in Brazil. Okay. I think there's something to be gained in Argentina and maybe Chile. Again, I wouldn't go looking at exposure to those individual markets, and I wouldn't be trying to pick timing. But I think what we're seeing is an increase in domestic consumption in the in the developed markets, so the US, the UK, Europe, and I think that then will cause the central banks not to have to raise interest rates too quickly. So if we get a steady interest rate environment, that's good for the emerging markets. So I think at least for the early part of the year, perhaps the first 6 months, there's a play to be had around some of the emerging markets in LATAM, which is probably a continuation of what we saw in the last 12 months.
Does that also apply to Africa?
Africa, I think, is very different. I'm not a great proponent of the African economy. It's not an economy that I really understand. It's fairly new, I think, to the global market outside of South Africa. And I think if it was me, and I really wanted to have some exposure to Africa, I'd probably look at MENA, so the Middle Eastern economies, as the Gulf grows. But I'd look at Kenya, Nigeria, and South Africa as markets in Africa. And I think they're very much agricultural stroke, mining play, a commodity play, oil, softs. South Africa, a much more developed economy, but obviously currency controls and different things. But those are probably the only three I'd look for exposure to. And I'd look for them through a diversified fund that had holdings in manufacturers, industrials. As I say, I think commodities, the softs. I think Africa's becoming, the farm for the world, if you like. Chinese are clearly putting a lot of money into it, so maybe infrastructure plays there as well. And the Middle East, obviously it's a player in the oil economies, but I think it goes a bit beyond that these days as well. I think, yeah, it's diversified, and I think there's been talk for a long time of a single currency across the Gulf. And that becoming a reference currency for the world. Now, I don't know whether it will happen. It will obviously be oil-backed, I would think, not gold-backed, but it could happen. Not necessarily in 2017, but as it picks up, momentum, I just don't see the US dollar remaining a global reference currency in the way it has done over the last 40, 50 years. I mean, this is a very personal view, and I don't know that many people would agree with it. I think, popular belief is China have been hoarding gold, biggest net buyer of gold in the world, alongside Russia. And I think we could see the renminbi gold-backed released as a global reference currency in the next year or two.
Okay, then moving away from all those Middle East, moving west into Europe, what else going on there?
Yes, and I think that confusion remains all year, and probably beyond. Would I be an investor in Europe? No. Would I be even a limited investor in Europe? Not if I had a choice. But I think it will always be in these global multi-asset funds, because again, when put together, it's a big economy. If I looked at Europe, UK, I think, will benefit from Brexit. I think will benefit strongly. I think we'll see a resurgence in the pound. I think when Brexit gains momentum and Article 50 is triggered and we begin to see the negotiations go on, I think Britain will be a winner, personally. And I wonder what that does then for the rest of the EU economy. The only one that I can see survives on its own and is a strong enough economy to want to invest in would be Germany. And today, if I could find a fund that was German orientated, and looked at maybe the car manufacturers, some of the other industrials, solar panel manufacturers, people like that, I would be an investor. I think Germany is a strong manufacturing base. Outside of Germany and Europe, I'd only look at Britain. And whether we now include Britain in a Europe or see it as an individual economy, I don't know. I would still say today it's part of Europe. It's a European-based economy. I think it will attract money. After triggering Article 50, I think people will see it as a safe haven. I think the euro will lose strength against the dollar, will lose strength against the pound, even more than it has done over the last year or so. And I see the pound gaining against the dollar. I see the dollar maybe dropping 30% from where it is over the next 18 months. I think it's a pretty false economy and a false position that the dollar's in.
Interesting. Well, okay, Nigel, we've covered pretty well every continent now. We haven't mentioned sort of New Zealand and Australia. Any comments on those two?
Know nothing about New Zealand as an economy, Bruce. Would see it not as an investment port for a retail investor. Australia very much a commodity play, I think. I mean, if we were to see a strengthening of the Australian dollar, then I think there could be some money down there. And if we see again a commodity play, farming, softs and mining type commodities, then again Australia could be worth.
You mentioned that there's always a good play in China, and then if the China booms again, the Australian might.
It may well drag the Australian economy up with it. I think Australia's always been a big trader, certainly in modern history with the Chinese, and we're probably the biggest supplier of commodities to China, and they've suffered on the back of it, obviously. But I very much see, yes, if China begins to rally, and as I think a lot of people, as I read, and a lot of people seem to believe, China goes this year back internally and does infrastructure projects and more building projects, continues to re-site factories from the border with Hong Kong up to central China and builds new infrastructure to support that, then I think we could see China demanding more and more commodity again, more and more metals, building related metals, steel and stuff. And I think that will benefit some of the other economies around them, Australia included.
So, and finally, Nigel, if we were going to take, let's say, $100,000, how would you divide that up around the world? And you keep on mentioning commodities, obviously quite key on.
Yeah, look.
How would you divide that up?
I think I personally would find, as I say, a global multi-asset type fund. I mean, there's a few out there, Kestrel Managed Portfolio, there's Mansard's Physical Asset Allocation Fund, which is very much an algorithmic driven fund. I think Jupiter Merlin, GAM. No. I would probably use that as my core holding, maybe 50 to 60%, knowing it was actively managed by an institutional manager. That would allow me as the retail investor to sleep easily at night, or even in fact as the advisor to the institutional investor. And then maybe around that I'd make some plays in individual countries or individual. I mean, I'd very much look, as I say, early in the year at emerging markets, so maybe a fund that covered 3 or 4 countries in LATAM that we spoke about earlier, maybe a fund that played Russia as well, Russia, India, China. But I think if you go for that global multi-asset allocation, that is very much going to take into account all the things we said earlier in the interview. So very much they're going to have exposure to all those markets, but they're going to manage that exposure, and look for something that controls volatility, because I think it's going to be a bumpy ride. But in terms of the money outside of that core holding, you could play some of the small markets that could be exciting, and Mongolia, which is a big mining economy.
Again, dependent on China?
Very much dependent on China, but I think also probably looking at Russia. There are obviously trade agreements between Russia and Mongolia, between Mongolia and China, and very much I would see them as being their strongest partner, certainly for coal and stuff like that gets taken across the border. But for some of the other stuff, for some of the other stuff that can be mined out of Mongolia, depending on how freely it can be got out of the country, I think that could be quite a strong economy. It could be an interesting play, but only 5 or 10% exposure. Personally, I'd be having a look at the hard commodities, maybe looking for a physical gold fund or physical precious metal fund, maybe a 20% investment, and then I'd be looking now to hedge my equity play in that multi-asset allocation fund with an exposure to a CTA. CTA's probably not been very popular over the last, probably since 2008. Sorry, a commodity trade fund. So it looks at all the liquid markets in the world, would very much trade the currencies, would trade metals, would trade softs, so agricultural commodities. Probably does it through options rather than total exposure to buying stocks. and has traditionally had been a hedge against volatile stock markets. And I think this could be the year, if I believe everything I've read. I think a lot of the CTA managers have been rewriting algorithms because volatility in terms of the market is shortened. It used to be volatile, markets were volatile over 2 or 3 months. Now they seem to be volatile over 2 or 3 days. And that's meant a lot of the hedge fund managers have missed out on gains. Retail investors have missed out on gains. And I think this time round, if I believe that they've shortened the algorithm, shortened the period over which the algorithm looks, then I think the CTA could be a great hedge. I wouldn't like to recommend a CTA manager, but I think that there are some out there that are retail orientated and they can be got into without too much money, too much exposure. And I think very much they could come into their own in the second half of the year.
Okay, well that's a very interesting summary of the entire global economies. And
it's a sad summary.
Yes.
I think it could be a very difficult year, 2017. It could be a year of correction.
Your overall input and look at all the continents and all the potentials and the different asset types. Very interesting. And let's fingers crossed and hope that it'll be not as testing as we expect.
Fingers very much crossed, and let's hope that Mr. Trump leads the world out of a potential slump and into a profitable place. Yeah.
Okay. And we'll leave it there. And thank you very much, Nigel. For coming
Pleasure,
in.
Bruce. Thank you.
Sharing.
Thank you.
And so that's the end of today's interview about all the global economies and the potential coming up. And I hope you found that useful and interesting. Bye for now.